In this video, I'm going to walk through the top 5 dividend ETFs of 2025. If you are looking to build a dividend portfolio that will one day replace your W-2 income, then you need to be familiar with these ETFs, whether your portfolio is 5 figures, 6 figures, or even 7 figures and above. By the way, my name is Brian. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you build your net worth and invest with confidence. So let's dive in, and the first ETF that you should know about is called JEPI, which is an equity premium income ETF from JP Morgan. This ETF has a dividend yield of 7.34%, which is one of the highest on this list. That means that for every $100,000 you invest in this ETF, you can expect about $7,340 in dividend payments every year. If you're wondering how much is needed to replace a full-time income, it will take a portfolio of about $1,098,228.88. Yes, the 88 cents are important, to generate $80,610, which is the current median household income according to the latest data. And $1 million might sound like a lot of money, but subscribers to my channel should know by now that building $1 million portfolio is a lot easier than you might think, even on an average income, as long as you're willing to consistently put away money and invest in sensible assets for the long term. And before we move into the second ETF, it's important to remember that dividend yield is not the only number that matters. Some of these ETFs will have higher and lower dividend yields, and they will all have different portfolios of stocks that they are using to generate that yield. Additionally, when you're earlier in your investment journey and building a large dividend portfolio, it's probably a good idea to reinvest any dividends that you get so you can benefit from compound interest. That's why it is just as important to look at total return in addition to dividend yield. This ETF from JP Morgan, for example, has a total annual return of over 12% since its inception in 2020. And compared to other dividend ETFs, this portfolio has its largest exposure to technology companies as well as the finance, healthcare, and industrial industries. So the next dividend ETF that I think you should know about is one that I think is very attractive, and I'm curious why it doesn't get talked about more often. And it's called DGRW, which is a quality dividend growth fund from WisdomTree. This ETF has a dividend yield of just 1.07%. But what makes this fund so interesting is that instead of focusing on companies that are paying the highest dividends, DGRW invests in dividend companies that are growing the fastest. The result is a portfolio that's a bit heavier weighted towards technology stocks and almost no real estate or utilities industries, which are typically the industries with the highest dividend payouts. Personally, I like this fund a lot because in my experience with investing, it's important to not focus too heavily on one metric like dividend yield. After all, if a company is paying out all of its cash in the form of dividends, that can be a little concerning because it implies that that company has no or limited opportunities to reinvest that money and keep growing their business. And by investing in companies that both pay dividends and have high growth, WisdomTree has been able to generate returns of about 13% per year since their inception in 2013. Even though the last ETF was probably my favorite, the next three are just about as good, and some might argue they're even better depending on what you're looking for. This one, in fact, is quite popular among the dividend investing community, and the ticker symbol is SCHD, which is a more traditional US dividend ETF from Schwab. And what sets this ETF apart is that it's designed to invest in the top 100 US companies that have high dividend yield, as well as strong track records of consistent dividend payouts and strong financial profiles compared to other companies in their industry. This strategy, in my opinion, is a very solid strategy, and it results in a dividend yield of 3.63%, as well as a total annual return of 13% per year since the fund began in 2011. And compared to the previous ETF, which was more heavily skewed towards technology, this dividend ETF has more exposure to industries like financials and healthcare and much less exposure to technology. And what I love about this ETF is that it just goes to show that you don't have to chase after these high-flying or highly volatile tech stocks just to get double-digit returns in the long run. In fact, if you were to invest just $10,000 per year, earning 13% per year for the next 30 years, you'd end up with $3.3 million. And if you're in a fund like SCHD earning 3.6% on that $3.3 million, then you would have $118,800 per year just in dividend income. For some investors, though, companies that just pay dividends consistently might not be enough, and that's where this next ETF comes in. DGRO is the iShares Core Dividend Growth ETF, and as the name implies, this ETF wants more than just consistent dividends. This fund invests in US stocks that have strong dividend growth, and on their website, they say that they're broadly diversified across industries, but we'll come back to that in a minute. The reason that dividend growth is important is that some companies can outgrow their dividend. For example, if a company is trading at $100 per share and they pay a $3 dividend, then their yield is 3%. But let's say over the course of a few years, the company's stock has jumped to $300. If they keep their dividends consistent at $3, then your dividend yield is now 1%, which means you're getting less dividends per dollar that you invest. DGRO focuses on companies that grow their dividends over time, and the idea is that the yield on these companies will continue to stay high, whereas others may go down over time. When it comes to industry exposure, iShares says that their ETF is supposed to be broadly diversified, but when you look at their holdings, I don't know about you, but that looks a little skewed to me, and that's not necessarily a bad thing. When it comes to dividend growth, I think financials and technology companies are great industries to focus on, but I wouldn't necessarily call this portfolio broadly diversified. But that's why you have me to help you break down these investments so that you can make better decisions in your portfolio, and we can hopefully all make a little bit of money in the process. There is one more ETF that I think you should consider if you're looking to build a long-term dividend portfolio that could one day replace your W-2 income, and that is DVY. DVY is the iShares Select Dividend ETF, and at first glance, it doesn't look all that special. In fact, the fund is similar to SCHD in that it invests in the top 100 US companies that have relatively high and consistent dividends. It has a 3.7% dividend yield, and when looking at total return, it seems lower than the other ETFs that we talked about at just 8.43%. But whereas the other funds on this list have around 5 to 10 years of history, DVY has been around since 2003. This means that DVY has remained resilient through multiple recessions, including the Great Financial Crisis in 2008 and 2009. And since we're talking about investing for the very long term, we're talking 20, 30, even 40 years, I wanted to include an ETF that has a track record that could show that it can go the distance in your portfolio. And speaking of your portfolio, dividend ETFs are just one of many strategies to reach your net worth goals. And in this video, I cover another investing strategy that you might be interested in where I use just 3 ETFs to generate double-digit returns.